This month, we have a very special guest with us in the studio, Terence Tsai, an investment equity analyst at Fidelity, based in Hong Kong. Welcome to Singapore, Terence.
Thanks for having me.
So Terence is our first guest and hopefully the first of many to come. So April was really a rough month for markets. Inflation continued to remain quite sticky. Q1 GDP data in the US also underwhelmed. April non-farm payrolls also came in under expectations. And that really caused a reshuffle, a rearrangement of investors' expectations on rate cuts for the rest of 2024. So Terence, any thoughts on how the earnings season unfolded?
The earnings season was better than expected. Most companies outperformed expectations on the upside. And that really goes to a continuation on the strength of the US consumer. Investors also start to look through near-term earnings weakness, even if they missed, and look for guidance and outlook from the companies. And while it's a good sign that earnings have been better than feared, it's important for earnings momentum to continue because of where valuations are currently, so that we can justify current valuations.
So at Fidelity, our base case for the rest of 2024 is for continued economic growth. But we do think volatility will remain as the timing of monetary policy remains uncertain and geopolitical risks can potentially impact inflation.
Hey Chris, so how are regional clients feeling? Any jitters given the rough April you mentioned?
Well, actually, optimism remains high, right? The preference for equity remains high as well, especially for the US, Japan, and for technology stocks. So investors are also starting to pay attention to Chinese equities, given the strong run they've had since the Chinese New Year back in February. So this is substantiated by recent easing measures. So for example, the Chinese authorities released a 9-point guideline aimed at building a fair and efficient capital market, and really that's to draw foreign investors back to the market. So in fixed income, high quality investment grade bonds remains quite a consensus trade as investors look to lock in elevated yields that still stand at close to 17-year highs.